Hi there, everybody. So, hey, welcome to the webinar today. I'd like to thank everybody for joining. I think I'm pretty excited to share this information with all of you. And I think one of the biggest reasons why I'm doing this is because the banks are so busy right now that they're looking for ways to do easy denials for their clients. So if somebody submits an application that's missing anything or if it's deficient in any way, the banks are just sending out denials. And so the goal for everyone today is to learn from me. I've been on the lender side of about $15 million of transactions all across Canada. The goal is for me to teach you guys how to put your best foot forward, how to make sure you're not missing anything simple, so the bank can't just brush you off. So there's a couple more people waiting here. I'm just gonna give it a couple minutes to let everybody join. So where are you guys calling in from? You guys are on mute. Can you unmute yourselves, or do I have to unmute you?
Hello. Can you hear me?
Hey, Eric.
Hey, thank you for hosting this, Matt.
Of course.
Yeah, I'm calling in from sunny Vancouver.
Yeah, it's a beautiful day today.
Absolutely.
I'm from Brampton in Ontario.
Hey, how are you? What was your name again?
Manoj.
Manoj, hey, good to see you in person.
I'm here.
And how about you, Daniel? Where are you calling from?
Hi, everyone. Hi, Matt. Thank you for hosting this. I'm calling from Calgary, Alberta.
Welcome, welcome. Kathy?
I'm from Langley. Hi, everyone.
Hey, welcome.
Hi, Kathy.
And Sasha, how about you? Where are you calling from? Oh, there's a chat. Oh, Sasha says she's from Toronto. Well, you know what? I'm not going to wait too much longer. Let's just get started. So I'm going to share my screen. Yeah, I'm going to share my screen. Now, for anybody that's watching on Instagram Live, Facebook Live, or YouTube Live, I can apparently receive your comments. So if you have a comment, please feel free to send it through the respective channels. So let me just switch into sharing my screen and we'll get started. Okay, hang on. Sorry about that. Bear with me. Okay, so obviously today, the focus of what we're doing is basically making sure that you guys can get a yes from the bank with minimal grief from them. Now, again, we talked about why. So the BDC, for example, received more applications in March of this year than they received in all of 2019. There's a typo there. More applications in March this year than they received in all of 2019. And this means that they're looking to cut down their workflow. I mean, obviously, we're looking at, it's not just the bank we're talking about individual account managers who are busy, who have their own families. And so they're looking for any way to cut down their workflow. And I don't mean to say this unfairly, but it's easy for them when they get an application that's missing a whole bunch of stuff or that doesn't look right to just send the denial back so that they can get back to their families. So this is why I wanted to share this with you guys. Now, one of the biggest things, there's two really big things I want to teach you today. One is how to think like a bank. The other is how to prepare an application that's not going to get dismissed. So when we want to think like a bank, we also got to think about what does the bank want? I mean, it's pretty simple. Like the bank wants their money back with interest. They also want it back with as little effort as possible. And so when you're looking at your application, when you're thinking about raising financing, you want to have your eye on what is going to, oh, sorry, hang what's good? How can you present your information so that if they look at this and they go, oh yeah, we're going to get our money back. We're going to get our money back with interest, and it's not going to be a whole bunch of work to get our money back. They're not going to have to call you to make payments. They're not going to have to restructure your loan if you're in trouble. So everything you do when you create an application, look at this from the bank's point of view. How can I, like, and ask yourself, if I was the bank, how am I going to make sure I get my money back? So everything you do in there, you're going to have to think of that. Yeah, Eric said, will the slides be shared after? The slides will absolutely be shared after. I'm also going to share a bunch of tools. So everybody that's on the webinar is going to get a bunch of free tools from this. So we've talked about what the bank wants. It's pretty simple. Money back, easy. Now, what does your bank manager want? Because you're not interfacing with a bank. You're going to be talking with a bank manager. And so what does a bank manager want? Well, a bank manager wants to they want to get their deals done and earn their commission. Obviously, they're, and they're not bad people or anything like that, but they're like everyone else. They have mouths to feed at home, and they just want to get their deals done. They want to do their job, and they want to get their commission. And again, they want to get their commission with as little effort as possible. So if you can make a package that's complete, that's easy for them to read, easy for them to find all the information, guaranteed, number one, you're not going to get an easy dismissal. Number two, you're going to greatly increase your chances of getting the financing you want. And there's a couple reasons for that. One is because, they look at you and they're going to go, okay, well, it's easy commission. It's an easy deal to do. The other is that you're going to make yourself look really smart when you come to them with a complete application. You're going to make it look like you know what you're doing. And most of you guys are I would say, it's pretty obvious that you're good business owners, right? But this is you proving it in the language of the bank. Okay. So always think in terms of, what does the bank want? What does the bank manager want? Now, the question is, how do you prove that you have a good deal? How do you prove you have a good deal? So there's a couple things. Cash flow. You need to prove that you're going to have the cash flow to pay the bank back. And we're going to get into exactly how you prove that in a little bit after this slide. So basically, one of the biggest pieces of your application is proving that you have cash flow. Now, you do, but you have to convey it in the language of the bank. EBITDA. Now, EBITDA is an acronym that stands for earnings before interest, taxes, depreciation, and amortization. Now, this is a metric that the bank uses to qualify you. This is something they use in all of their work. And so you're going to have to know what this means. I'm going to show you exactly how to calculate EBITDA when we go to the spreadsheet. Now, again, it's earnings before interest, taxes, depreciation, amortization. And this is what the bank uses when they look at qualifying people. Next, debt coverage. So what you want to do is you want to prove that you have enough cash flow, enough EBITDA to fully cover the loan payments, and plus a buffer. So you want to show them that you're not just going to like barely break even. You want to show them that you're going to be able to break even, and you're going to have a buffer to cover things that are maybe unexpected. And if you can do that, they're going to look at the loan, and they're going to test your calculations, but they're going to look at the loan and they're going to go, oh, great, they can pay us back. They're going to have a buffer. This looks like a safe loan. This guy or gal looks like they know what they're doing. Collateral. So collateral is another thing that the banks are looking for, obviously. And there's a number of pieces of collateral, a number of types of collateral that we're going to talk about. And this is going to be a couple slides from now. So before we dive into collateral, what we're going to do now is we're actually going to look at a sample set of financials in an Excel spreadsheet, and I'm going to show you how you should lay it all out to make your bank manager, make the bank happy. So hang on one second. Okay, so let me get to my spreadsheet here. All right, share my screen again. All right, so you probably see a big ugly spreadsheet with lots of numbers. Don't worry about it right now. We're going to go through everything line by line so you understand what I'm doing and why and what you should do. So obviously, the first things you see are a forecast 2021, 2020, and then you have your actuals. So the very first thing you're going to need to do is, let's ignore this for a minute. Okay, so let's talk about your actuals. So the bank is going to want to see your last 3 years of financial statements prepared by your accountant. And you're going to have to put it in Excel for them so they can see what it all looks like. And they would do this themselves, but if you do it first, it's an opportunity for you to take control of the narrative, which is super important, okay? All the work we're doing is going to help you take control of the narrative so that you can kind of get ahead of the questions that they have before they ask them. And again, you know, going to make you look awesome. So this is, you're just simply putting in what's on your bank manager, what's on your financial statements that you get from your accountant. Now, hold on 1 second. Just making sure that I'm not locking people out of this. So, okay, so this is it. This is pretty easy. Put it all in. Now, a lot of you will have a bunch of different categories of expenses that you can see. You're going to get this tool. So just overwrite all these categories with your own expenses, okay? And then plug in all the numbers just the way you find them on your bank statements. Now, what I want to highlight right now is you'll see that in 1 year, we have negative income. So you shouldn't be worried about showing them that. The reason why is because they're going to find out anyway, but this is also a great opportunity, like I said, for you to take control of the narrative. And so let's talk about that. So your net income here is negative 61,000. So I mean, a lot of you might think that a bank is going to look at that net income and kind of panic and go, okay, if you were in a net loss, we're not going to give you any money, but that's not always the case. First, we're going to look at how to calculate EBITDA, which is here. So you take your net income, you're going to add your interest back, you're going to add your taxes back, you're going to add your amortization and depreciation. That is your EBITDA, okay? EBITDA stands for earnings before interest, taxes, depreciation, amortization. This is the #1 metric the bank uses to test whether you can qualify. So make sure you know how to calculate this. And again, you're going to get this spreadsheet. Anybody who signs up, anybody who's on this webinar will get the metric. And if you're on Instagram, YouTube, or Facebook, go to 8x.co/subscribe. If you subscribe, ask for these tools and you can get them. Okay, so again, we see that even with the EBITDA adjustments, you get to add back $60,000 in interest. Even with that, your EBITDA is negative. So again, I don't want you to panic, and your bank manager will panic unless you take control of the narrative. So here's what you do next. The next section is called normalizations. This is the section for you to take control of the narrative if you have income that's not as good as you'd like it to look, okay? This is the main section, okay? What are normalizations? Normalizations are opportunities for you to explain to the bank ways that you can increase your income, or maybe things that happened in 1 year that aren't going to happen again. So you should add them back, and the bank shouldn't consider those in funding your loan application because it was an isolated event, or it's something that isn't going to happen again, or it's something that you can actually save some money on in the future. So these normalizations is a huge, huge piece of this. Okay, so first thing you'll see here is owner's wages. Yes, I'm telling you to put up your wages here. The reason why is because the bank is going to want to see that you're willing to reduce the money that you get in order to pay back the loan. That alone is going to give them a ton of comfort if you've already gotten ahead of that question. They're going to ask it anyway. But if you get ahead of it and you say, oh, you know what? I usually make 70 or 60 or whatever you make, but I'm willing to sacrifice 35,000 of that in this particular example to make sure that I have enough money to pay the bank back, you're going to impress them like 100%. Okay. The next thing is professional legal. So I'm going to say in this year, something happened. Maybe I had to start a new corporation. Maybe I had to pay something extra to do the special tax thing. That's not going to happen again. So they shouldn't take that into account. Meals and entertainment. A lot of private business owners, and rightly so, they use their business to kind of add to their lives. And so there's some meals in a business, and this is very common, and accountants know this, and banks do too. Some meals and entertainment that you don't need to spend as much because you're kind of just enjoying having a business, which is, if you're not enjoying having your business, what are you doing? So you're going to tell the bank, oh, you know what, I can save money here. So let's add that back, okay? The next thing is, in this particular case, this business owner in sample company, they had a machine breakdown in 2019, and that's not going to happen again. Okay, so we're going to add that back to this net loss that's here, and we're going to say that, oh, you know what, in a normal year, that income would have been 82,000, not -3. And the reason why is because when I have your money, I'm willing to put up my wages. I'm willing to reduce my spending on meals and entertainment. And this thing that broke, that's not going to break again. So what you should really consider as my income is this 82,000. This is the biggest piece, okay? I don't want to understate this. It's huge. The other part of this is you need to make a reasonable adjustments here. So don't add back all of your wages because the banks usually want to know that you're taking money too. And don't add back all the meals and entertainment because the bank wants to know that you're spending appropriately to build your business and whatnot, okay? And don't add back all your repairs. Now, once this normalizations are done, we're going to go back up to the income statement and make a couple notes, okay? So we see that in 2018, 2019, the advertising jumped up. Well, it's just simple. We spent more money on advertising to prepare for growth, okay? The interest, just know what it is. We got a ClearBank loan, we got a merchant growth loan. This is what it is, no big deal. The payroll, we added more staff. And then the repairs is a bigger one. Because what we say is, the machine broke down in 2019. We're planning to spend more now on annual maintenance, so this doesn't happen again. So you want to prove to them that you're looking forward, you're planning well. Okay, so this is the actuals, normalized EBITDA. You've greatly increased it from what the actual EBITDA was, but you've made reasonable adjustments that you're going to have to explain. But as long as they're reasonable, the bank will accept them. So now let's look at the forecast. So this doesn't have to be super complicated. If you're applying for a loan that's like under 500,000, probably they're not going to need detailed analyses usually, and especially right now. They're not going to need detailed analyses. So these numbers, I've just put them in based on where I think things are going. From 2019 to 2020, it's not a great year because of the pandemic. So revenue is going to decrease. Cost of goods sold is going to hold. And this is how I think I'm going to adjust my spending given COVID-19. So I'm going to reduce advertising. My auto and truck expenses are going to stay the same just because they are. Bad debts assume will be the same. We can actually push that higher if you wanted to. And I'll show you why you might do that in a little bit. Okay. Then again, I'm not going to go through it all. I'm going to give you this exact sample workbook, but we're just adjusting things. The interest, we're going to, the reason the interest is dropping in this particular case is because you're getting a new loan from the BDC, let's say, and it's going to be less interest than it was with ClearBank. And then staff is decreased a little bit. So you're just kind of doing a quick forecast. And this here is the repairs and maintenance. You're saying, well, in 2018, I spent $1,200. I'm going to start spending 25 grand a year to make sure I don't have any major breakdowns again. That's going to make you look very, very smart. All right. So then we have our net income. It's just, it's just a calculation here. Then we have our forecasted EBITDA, which is okay. It's fine there, right? Then we add in our normalization adjustments. So again, we don't have any normalizations that we're going to adjust because this is the future. But again, you're going to put up your wages. And what I'll say about the wages is it looks really good to a bank when you put up your wages. However, it doesn't actually have to be your wages that changes. It just looks a lot better for a bank. Money is what they call fungible. It means you can take money from meals and use it to offset wages. You can take money from advertising, use it to offset wages. So you're going to say it's your wages, but when it comes down to it, you don't have to actually reduce your income. You just have to find that 35 grand anywhere in the statements to support your loan. Okay. And then, you know, you have some, and this is what we call the debt coverage right here. This is DSCR, stands for debt service coverage ratio. The bank wants to see a DSCR of 1.1 or above, often 1.2. So we're going to calculate this for them because, again, if you know how to calculate this, you know what they're going to ask for. Okay, so you have existing loans, those are just going to stay the same. This is the new loan, and this number, if you use this calculator right here, it'll give you this number. So I've created that for you, and again, you're going to get this exact same spreadsheet. And so your total loan payments across these years are there. Your DSCR are there. You see that this one, for example, is below 1.1. That's going to be okay because it's the COVID pandemic time. They're not going to stress about that. But as long as you return to a strong DSCR in the next year, they're going to be fine with it. All right. So this is, again, how you're going to display your historical and forecasted financials for them in a way where you get to control the narrative and you get to kind of shape them. There's a concept in negotiation called anchoring. Anchoring kind of means that if you set the first number, they're anchored to it. They're only going to deviate plus or minus from there. If you don't anchor them, they're going to set the number wherever they want, and then you have to deviate from their number. So what we're doing is we're setting the anchor. Huge, huge, huge. Don't want to understate this. We're setting the anchor here. Okay. So the two biggest pieces of this anchor are the normalized EBITDA and the normalized DSCR. And they're going to go, oh, I don't think you should add back that much, or oh, I don't think, you know, they're going to push and pull your numbers, but again, they're anchored around the narrative that you've just given them. So very big piece of the puzzle. So the next thing the bank wants is a cash forecast. We're going to get into that now. This is the historical plus forecast. We need to do like a cash, so money in, money out forecast for them. This is what's next. All right. And again, we're going to have time for questions at the end of this presentation. So if you have some, write them down or put them in the chat and I'll find them. Okay. So cash forecast, again, a big ugly spreadsheet with numbers. Try not to be overwhelmed. I'm going to talk you through them. So now cash flow, revenue. This isn't revenue as in income, as in what you're going to earn in the year, because you'll notice that this 465, which is your forecast cash in 2020, does not match what you forecasted for total income. What this means is you're telling the bank you're going to earn 650,000, you're going to sell 650,000 in 2020, but you're only going to collect 465. And a lot of businesses work that way. Some of you, and I know Manoj, your business is like this actually. You're going to sell something and it takes them however long it takes them to pay you. So this is totally legitimate. And we're doing this on purpose because you get to, with the cash flow forecast, it's really just you estimating what you're going to be getting and not getting, right? So the bank can't tell you what you're going to be doing. You're going to just tell them. And the reason, and I'm going to show you why we structure it this way. Okay. This is your cost of goods sold. So again, you see that there are some months where you don't spend. A lot of businesses have this, and Manoj, you're the same. You spend money on cost of goods sold, and then it takes some time, and then you sell it, and then it takes some time to get the money back. And so you're showing the bank that your cash flow is lumpy. So in Q1 2020, for example, you had to buy $117,000 of cost. And then you're only collecting a little bit because it's pandemic times and no one's paying their suppliers on time, right? And you can use this to paint the picture. okay? And specifically when it comes to the support funding from the government, there are a lot of cases where you're going to want to paint a more negative picture so that you can get more money from the bank. This is strategic. You're not making it look like your business is not good. You're just trying to get more money out of them. Okay. And then, I'm not going to go into this exactly, but this is just all your expenses. You can use round numbers. The bank knows that, from someone like myself, I'm a CFO, the bank will expect pretty granular analysis here. But from your average business owner, they're going to be impressed with this. So it's okay to use round numbers in here. And you can use these to kind of toggle and play with your cash flow. Okay, so again, revenue and COGS is very important because usually those are the biggest influencers of your cash flow. And then you have the balance of your expenses, which we're not going to spend a ton of time on. But again, this is in this model here. Now you have your net cash flow. So cash in minus cash out equals your net cash flow. And you can see that in Q1, we told the bank that there was a net cash flow of minus 59,000. And there are a few months where you have other minuses and a few months where you have some pluses. This is very, very normal, but not your business is the same. I'm sorry, there's a few others here, but I don't actually know your businesses, and your names look like they're my name. I think that's because I gave you the wrong link, but I'm sorry. But again, in Q&A time, we're going to get into this more. And so then you want to show them your net cash flow in a month after the lending facilities. So in Q1, the business produced minus 59, but you had 65, and so your net cash flow was positive 5,000. In April of 2020, you got this loan, and it's too late to get it in April, but you'd use whatever months you have left. You got a loan for 250. You paid the first month payment. You used your wages to buffer the loan, and so your net cash flow was, for that period, was positive 244 because you got this loan. And then you can see that you had to spend a bunch of cost of goods sold here, and you're not getting a lot of payments here, a bunch of cost of goods sold again, and then your people are starting to pay you again. Things are going back to normal, okay? So what you're gonna see is your net cash flow is not great, not great, not great. Then it starts normalizing again. Your cumulative cash flow, so cash flow from Q1, and then this is like this line here is what's gonna be in your bank at the end of each month. So this is how much cash your company will have. Now, you can see that when you get the loan, it jumps up and it slowly dwindles because, again, business isn't great for anybody, but then it starts to normalize and come back up. And so without this 250, watch what happens. You are in the hole in a big, huge way, okay? So let me put it back. So what you're telling the bank with this is that I need your 250 to keep my business afloat. If you don't give me that 250, I'm going under. Okay, and this is what the financing is there for when it comes to the COVID financing right now. And if you're not looking for COVID support financing, do all the same stuff, but just don't, just make sure you pitch it where like this is for growing the business. So for example, what you might do is you could say, if I don't get the 250, I won't grow as much, that kind of thing. But this same analysis is incredibly useful. Or for example, if I can't get the 250, I can't buy this cost of goods sold right here, then that means I can't sell this. And so that's how you pitch it if it wasn't specifically COVID support. But if it's COVID support, and if you have an existing business right now, I would recommend trying to get the COVID support financing because it's just easier to get right now. So again, if they give you the loan, your bank account stays above zero, and then you make it, and then in 2021 you're back to normal making money over here. Without the financing, you're not going to make it. Okay, so this is how you do the cash flow forecast for the bank. That's about all I'll say. And again, you put your 2021 forecast here, and again, you're going to get this exact model, exact spreadsheet. Okay, so there's just a couple more slides to talk about. All right, so let me share my screen real quick. So I'm just going to take this opportunity to let everybody know that I've created a course. This course is specific to people that need any kind of financing from a bank. Because it's the COVID pandemic right now, I'm offering the course for quite a heavy discount. Chat. I think I saw a question. Oh, yes, Eric, I saw your question. Cumulative cash flow is the money carried over month to month. Yeah, that's right. So if you think about cumulative cash flow, it's like in January, you had $100. February gave you $15. So at the end of February, you have 115. Then March, you lost 15. So the end of March, you have 100 again. So it's that kind of floating balance in cash. Good question. So real quick, just introduce this course. I don't want the bank to brush you off, but we obviously don't have 3-4 hours to go through this on a webinar. So I've created a course to do this for you. Now, when I help somebody raise financing for them, go to the bank, the fee is about 2%. So on 100,000, that's 2,000. On 500,000, that's 10,000. On $1 million, I'm charging over $20,000 to help someone craft this proposal. This course is going to teach you all of everything you need to know to do it yourself. There's a bunch of hours of lessons in here. There's more detail on all the sections we're covering off in this webinar. In the discussion boards, I'm in there with you. You can ask questions specific to your business, get your answers. I also cover what to do if your credit score isn't great and how you might get financing if your credit score is not great. And in terms of if you purchase on the pre-sale, you're going to get my email to ask me questions about your business and to make sure that I put those questions into the webinar for specific answers for you and for other business owners that might have the same questions. And again, if you don't like it, if you're not happy, I'm not happy either. So 30-day money back guarantee, anytime within those 30 days, no questions asked. If you're not happy with the material, if it's not helping you, let me know, money back, no problem. Okay, so that's the course. Now, the last thing is we're going to cover is the types of collateral the bank is going to ask for. So one of them is obviously buildings. So sometimes a bank will want a mortgage. Sorry, I just got distracted here with something. Okay, so if you get a loan for a building, the bank takes a mortgage. That's pretty simple. It's similarly to how it works personally. If you buy a machine, the bank wants to take a security on the machine, which basically means that if you default on your loan, the bank takes the machine back. They also do inventory. So some banks will lend on the basis of, let's say you need to have 150,000 in inventory all year long. The bank will give you 60% of that sometimes. Some banks will, some banks won't. And so that's the collateral they'll use, because if you default on the loan, they'll just go and take your inventory, sell it themselves. Now, they don't like doing that. No bank wants to take your stuff away. What they want is they want you to pay it back, and without minimal effort on their part. They don't want to take your stuff. It's just there to motivate you to pay it back. GSA. Now, this is probably something you may not have heard before. A GSA is what's called a General Security Agreement. Any chartered bank or credit union will ask for this. The BDC does not. What a GSA is it's called a floating charge. It covers any assets in the whole business. So Daniel had a question. What was my charge to help a business build this application? It's 2%, and I normally don't work with folks that need less than 100,000, because less than 100,000 is not worth it, and it's also probably not fair, given that I have a course that's going to teach you to do it. This course right now is $39. If you use the pre-sale, you'll get it for $19. After May 8th, the price goes back up to $59. And so again, is it fair for me to take $2,000 from you when you can get it for $59 or $19? I don't think so. When you get to loans over 500,000, million, 2 million, 3 million, then I'd say you need me. You'd want me to do it because I have contacts. I'm a CFO, so I can do super detailed analyses. I can help you review the contract. I can help you negotiate what collateral you're going to have. And so that's why you'd want to use me if you had a loan over 500 or a million. But below that, the contracts are pretty simple, honestly. I placed one for a client of mine last year for 200,000. He was a CFO services client. So basically I come in as their CFO on a part-time basis. So that's what they needed. And the contract is so simple that it's not, you wouldn't need me for that. And so that's why I say, if you need anywhere from 0 to 500,000, maybe 400,000, just use the course. It's way cheaper. What if you're a startup was a question I got. There are two things you'll look for. One is called the Community Futures. They're a national group. They're for providing startup financing. You'll need a business plan and all these projections. I don't have a course on that yet, but they have some pretty good resources to help you do that. So Community Futures is one. If you're under 39 and over 18, you can look at Futurepreneur. They do loans up to 60 grand for startups. Other startups can get financing. What if you're a startup and you need 250,000? The BDC does do startups, but you need to have 25% of the money usually. So yeah, you can do it. Right now isn't a great time if you're a startup to raise money because the banks are everybody's in crisis mode. They're not looking for opportunistic lending. So it's tough. I mean, there are ways to do it. I had a line into BDC on someone purchasing a brewery, which is a startup. BDC was willing to do it. So if you're a startup and you need 250, I mean, I'm happy to look at the deal for you. I might be able to help. Oh, and the other thing is with the course, sorry, I forgot to say this. If you buy the course and then you decide you don't want me to help, or you want me to help rather, I'll give you 25% off my fees. Again, I can't really do it for less than $2,000, but if you buy the course and you want my help, I can do it for $1,500 for you. Okay, so back to collateral, and then we're going to open up for questions pretty quick. GSA. So if you sign a GSA agreement with a bank, what that means is that if you default on the loan, they can take anything your business owns. They can take your cash, they can take your receivables, they can take equipment, inventory, whatever. A GSA gives them a floating charge over all your assets, so they can take whatever they need to get themselves their money back. Now, this is very standard. Don't let it scare you. All banks want this except for BDC. And again, it's kind of fair. If they're giving you money, they have to get it back. And again, they don't want to use their collateral. They just want you to pay it, right? Personal guarantee. A lot of people ask, am I on the hook personally for this loan? The answer is absolutely. Now, again, no bank wants to use a personal guarantee to get their money back, but they're doing that to motivate you to pay them back, no matter what you have to do. So for example, this thing I placed with some clients last year, each shareholder was personally liable for the loan, which means that if they default on the loan and the bank can't get the money back from selling stuff in the business, they can then go to the shareholders and say, give us our money. And the shareholders have to find a way to get it, whether it's sell RRSPs or sell their cars or whatever. And again, every bank wants this. The reason they want it is to really motivate you to pay it back. They don't want to go after you, but they want you to be very, very motivated and engaged in paying this thing back. So that's the three main groupings of collateral. And for loans for from 0 to 500,000, it's going to be pretty simple to understand what the bank wants. But this is just so you know what they want. And again, if you have a really high net worth, you can lean on the personal guarantee if your inventory is not worth a lot. And so you can kind of swap these sometimes. Okay. So there's a bunch of questions and documents after this main part that you have to fill out for the bank. There's a lot of questions they're going to ask. I have a big document list and question list that I'm going to send to you guys when this is over. But they're going to ask things like, specifically for the COVID support financing, how has COVID affected your business? Have you gotten a payment deferral on other loans? Do you have new agreements with your suppliers? So for example, if your supplier says, oh, you can have the inventory, but you don't have to pay, you need to tell the bank that. So they're just going to go through how COVID has affected your business and how things are running now. But you're going to get a list from me here. Then there's a huge document list. The bank is going to want to see your last 3 years financial statements, your last 2 years tax returns. They're going to want to see your net worth statement of net worth. There's a specific from the bank. They're going to want to see that. You have to fill out a form. They're going to want your personal tax returns. They're going to want your accounts receivable and accounts payable. They're going to want to see any other loan agreements you have with the business. So there's a lot, right? But again, I'm going to send you a list of all of those. Now in the course, you know, we don't have time to go through it all here, but in the course, I'm going to create a section for each question and document. So you don't have to watch all of them, but if you're stuck on a question, click the video and learn what I have to say about that particular question and how to help that question get answered for yourself. And so, and the documents too. So some people, you know, if you sell to a client and they're taking a long time to pay, that'll show up as like a 90-day plus receivable, and the banks don't like when that happens. So you need to find a way to spin that to make it sound like you're going to get your money back, and not unreasonably, but you know, you want them to think you're getting money back. Okay, that's the end. We're going to open for Q&A. I'll quickly just mention the course again one more time. Again, for the people on this webinar, you have till the end of the day tomorrow to get it for 19 bucks. After that, the price goes up. And again, I have more detail on every section. You can ask me questions in discussion boards, which I participate on. You'll learn what to do if your credit score is not great. And in the run up to the course launching, it's just like in post-production. So it'll probably launch in a week or two, and pieces of it before that. So you can get working right away. But in the run up to that, you can email me any questions you have and I'll make sure they make it into the course. So that's it. I will stop sharing my screen. And if people want to go off mute, and if you have any questions, you're welcome to just unmute yourself or use the chat, which I can see here. So yeah, are there anybody have any questions about anything specific to them?
Hey,
Hey,
Matt.
Matt. Oh, sorry, Sasha, go ahead.
Go ahead, Eric. I can't wait.
Yeah, no, I'm just gonna ask. So for the course, in terms of the content and what we're gonna be learning, does it matter which kind of business you're in? Like, let's say if you run like a consulting business, which is more of a service, and you're not really selling products.
Yep.
How does that factor in when it comes to applying for a loan or for financing?
Right. The course will be applicable to any businesses.
Okay.
The one thing it may not be applicable. Actually, no, it's true. The course is applicable for any type of business. In the course, I will tell you what kind of businesses to talk, or what kind of lenders to talk to for your different types of businesses. So, for example, if you're a charity or a nonprofit, you shouldn't go directly to a bank. There are lenders out there that can help you. If your business is super strong, very financially healthy, you should go to a chartered bank, not BDC. If your business is kind of in the growing phases, you should go to BDC. So all that's going to be in the course. And consulting versus manufacturing versus retail sales, you'll all be able to use the information in the course. And like I say, I'll be in the discussion boards. So if you get stuck on something, you can let me know, and I'll answer it in the discussion boards.
Awesome. Thank you.
Mm-hmm.
Hey, Matt. So first, I want to thank you for all the information you gave us.
Of course.
So basically, the situation for me right now is me and my father are trying to start this packaging business.
Mm-hmm.
And specifically, we are writing the business plan for cosmetic packaging.
Mm-hmm.
And the numbers around that are the cosmetic packaging did 2.5 times better than even food packaging in the last year.
Okay.
So in terms of numbers, like we know it's kind of a business that is not even heavily impacted by Corona right now. But the issue is that it's going to be a startup, and we need around 250, 300. And I spoke with BDC. They said like that's the max they can do, and we can get started with that. So I was wondering, like, what do you recommend around that?
Okay, let me repeat a couple things back to make sure I'm understanding you, right? So you're starting a packaging business, it's around cosmetics. Now, were you saying that the margin on those products are better than what they normally are, or?
The sale for, so my father works for a packaging company, and the forecast they had for the past couple of months up to the last year, their cosmetic section is doing is doing really great. So even right now, like it's even doing better than food packaging. So
Oh,
the
I see.
opportunity is there, right?
Got it.
And it's a
Got it.
very specific kind of service that like you have like he's been doing it for over 6 years now. Like it's not something that everybody can, like the entry to
Yes.
market barrier is high too.
Mhm.
Yeah.
So have you guys started the business yet?
We are writing the business plan. We're getting clear on all the, like we are working with one person who's writing the business plan for us. I mean, like we are putting the information in and they're helping to just rewrite the plan.
Of course. Yep. Yeah, Kathy actually does that too. So, okay. So the BDC said they'd give you the maximum of 250. Do you have 25% of like of whatever you need? So if you need, do you have 50 grand or 70, whatever the number is there,
I actually don't have that, but what I was thinking was because I'm between the age group that you said, I saw that Futurepreneur has some
Yep.
fund. So I was
Yep.
thinking maybe when I finish writing the business plan, I can go to them, get the initial like some money there, and then use
Yep.
that as base to get the BDC.
Yeah. So what you can do is if 60,000 from Futurepreneur would be helpful for you and get you going for,
I'm sorry to interrupt you. So here's the deal. The 60K from Futurepreneur is like 25K is from Futurepreneur, and then the
Yep.
other 45 is from BDC. So would I still be qualified to go for, like, can I get 2 loans from BDC? Like, I don't understand how it works.
Yeah, you'd be able to. So if you got the 60K and then later on you were able to generate some sales and prove the business is kind of working, would you be able to go get another loan from BDC?
No. I need like 250 to start a business because like I need to like
Right.
the packaging. Like I need material. I need to, like, we can do the design. We can do the labor work. Our family, we are 4 people, so we are trying to like put all in. So we gotta pay like, the minimum amount of like salary and all that. So like we can put that work ourselves.
Yeah.
But we can, like, we need the initial, like we need, like it's a packaging business, so we need at least 250 to just like get it started, right?
Yeah, I mean, unfortunately, they're not going to allow you to take one loan and call that your contribution.
Well, what if I get the loan, like I get the 25K from Futurepreneur, not the other part that they get from BDC, and then use that and maybe like borrow another like 20 from line of credit or something too?
It would be hard to sell that to them, honestly. They're not going to want to see a startup financed with 100% debt is the biggest thing, and because there's just a lot of risk. Unless you have strong net worth. So if you have strong net worth in your family, like if your dad, if you guys are talking about owning a business in the packaging, your dad owns a different one, that's fine. I mean, you can use the
So
strength.
he's just like working for a big packaging company.
So that, I mean, that's going to help you, the fact that he has experience in that industry. Unfortunately, they're not going to give you a loan if you're 100% debt financed on a startup. I don't know of anybody that will do that. I mean, you could check into Community Futures. I'd recommend checking in there, get in touch with somebody and find out what they'll give you. There's a chance they might be willing to take bigger risks. That's what they're there for, is to provide finance. And that's why they call Community Futures, is they're there for community and wanting to help build entrepreneurship across Canada, because they realize that small business is the cornerstone of our economy.
I see. So if I get the 25%, then what are my chances after that, especially during these times?
They're good. If you get 20%, your chances are very good. Given that your dad has experience in that industry, I'd say the chances are quite good. And you have a legitimate business plan. Like, I'm sure you have someone good helping you, but the business plan is important and the cash flow projections are important. So what I would do with cash flow is have 3 cases of how your cash flow is going to work. So you're going to have a best case, like your kind of standard case. You're going to have a worst case. And this is going to help you control the narrative. So show them a case. I do recommend showing a case where you don't pay them back. The reason you do that is because they're going to look for that case anyway on their own. If you show it to them, you get to control the narrative. So for example, let's say your standard case, you pay them back and you have a buffer of whatever. Let's say your debt coverage ratio is 1.4. So that's, you're proving that you're paying the loan back and you have like 40% extra cash. Then the case where you don't pay them back, in that case, the sales are so bad that it's actually not a legitimate case even. So that's your chance to craft a narrative around that. And then your best case is where your debt coverage ratio is like 2.0 or something, very strong cash flow. So you can use pieces of your application package to control the narrative, and that's what I recommend.
Great. And in the course, do you like talk about like doing the like talking to them and doing the application and all that?
Yeah, the course isn't actually specific to startups. I'd have to think about for you if you could use it. So I would hang on a purchase for that, Sasha. Honestly, I don't talk about business plans and that kind of stuff in there. I'll think about if I should add that, and I'll let you know. Because it's a bit of a different thing. Might be good to do though.
So how can you help me with this?
Right. Well, I mean, if you have 25%, I can help. If you think you can get 25%, I can help. I mean, I could do the application for you. The course will teach you a bunch of stuff. It's just not specific to startups. Yeah. Sorry, I wish I had more to say on that.
Me too.
I mean, you're doing the right things. You're crafting a business plan. I've talked to you a little about your financial projections. So those are the right things to be doing. And you just need to come up with 25%. And then all of, the key focus, the first couple of slides were, what does the bank want? What does your bank manager want? You craft your application to answer those questions positively. So bank wants their money back. The whole point of your application is proving that you're going to pay them back. The whole point of your application is proving that you're not going to be a pain in the butt to deal with, right? Yeah, and I mean, I could help you privately, like not in terms of the course. I could help you do it for $250,000 loan or financing. My fee would be $5,000. So there's a chance I can help you that way. I don't know that I'll have time to make a startup course because I'm just putting the finishing touches on the other course.
I understand, takes time.
Well, we should keep in touch. Feel free to email me with a couple of your questions, and then I'll think about if there's a way that I can help.
I appreciate it. Just one last question. Would it be okay to so in the business plan, there's a section for people who are like kind of like consultant, who are experts in this field, and
Yep.
can I like put your name down as somebody who's like really has like a good idea about like around this, like around the financial aspect of it?
Yeah, so I mean, you could put my name down if I'm helping you. If you take the course, I would note that you took this course. But you couldn't use it from this webinar, I don't think. I don't know enough about you to really to back you. For example, if they call me and they go, "Hey, Sasha has this business plan."
No, I didn't mean like just like put it like that. I mean like, so what I have in mind right now is I'm gonna finish writing the business plan and getting maybe the cash flow ready.
Yep.
And then I will try to have a meeting with you, see if we can work something out.
Totally. Yeah. If I work with you, you can for sure use my name. I know a number of BDC account managers all across Canada, so they won't all know me, of course, but I know a bunch of them.
Thank you so much, man. I hope we can talk again soon.
Of course. Anyone else have a question? Manoj, do you have any questions? Or Daniel?
Thank you, Matt. No, not at this point. I guess it will be more on the private chat. If I can give a call sometime, explain my business, how it works, and what's our planning, because we do have a business that has worked for the last 5 years, but we're looking to build in a facility. I mean, something removable, so there's not that expensive. But I do need your guidance and perhaps your input in that matter.
Sure. Okay. Yeah. Feel free to email me, Daniel.
Definitely appreciate it. Thank you.
Absolutely. Hey, well, you know what? If that's all the questions, I want to thank everybody for joining. And if you've been watching on YouTube or Facebook or Instagram, again, thanks for watching. I think this webinar will stay live on there for 24 hours, I believe. And if you sign up for the newsletter at 8x.co/subscribe, I'll send the tools. This webinar won't be available for download, but I might do another one in a couple weeks. And again, check out the course. which I'll note in my email to you guys. So again, thanks everybody. I hope this has been useful, and have a fantastic day.
Thank you.
Okay.
Hello.
Oh, hey. Oh, Sasha. Oh, he left. Hey, Mom.
Hey, that was really good.
You think so?
I just jumped on just so I could watch you work.
Well, yeah, pretty good, right?
Yeah, pretty good. So the fee, the
Oh,
5,000.
hold on 1 second.